Rupee opened the earlier week a tad lower at 75.25 and registered a low and high of 75.38 and 74.69 in the period. Though the market is expecting to receive huge chunk of dollar inflows, the medium-term trend for the rupee is clearly on the downside, with the possible test of 75.80 to 76.00 level before the end of December 2021. The correction in the rupee to 74.60 level or better shall provide a good opportunity to importers to hedge their unhedged positions at least up to end December 2021 maturities to cap the exchange rate losses against the import payments due in the interim period up to end December 2021. With economies are reviving across the world, we are observing a continuous spike in India's exports in September 2021. Exports grew by 22.63% year on year to USD 33.79 billion, and the April-September exports recorded USD 198 billion, and the exports target of USD 400 billion in FY 2021-22 set by the government would likely to be fulfilled. Imports have spiked to USD 56.39 billion in September, attributed to an increase in imports of oil and gold. The non-oil imports also had risen significantly, widening the trade gap to USD 22.59 billion for September, the highest trade gap recorded in the last 14 years. The widening of trade gap is negative for the rupee, and this combined with other adverse factors could weigh on the rupee over the medium term. Due to rising Brent crude prices and the possibility of Fed tapering getting closer, we believe the recovery in the rupee may be limited to 74.60 resistance, and a test of 75.80 to 76.00 level is likely on the cards before the end of December 2021. We forecast the rupee exchange rate to range between 74.50 to 76.00 with a weaker bias up to the end of December 2021. Importers and exporters have to closely monitor and manage the exposures by hedging their payables and receivables at opportune levels within the above suggested range. After the RBI halted the GSAP auction, the bond yields are slowly climbing higher. The sporadic rise in US benchmark Treasury yields lifted the sovereign bond yields. The higher bond yields are also supported by global oil prices remaining high. Bond prices dipped following the weekly gilt auction, which also included the 10-year bond note. The 10-year bond yield ended the week a bit higher at 6.3640% after testing a high of 6.40% on Wednesday. Against August CPI inflation at 4.23%, in September, the October retail inflation is also expected to be above 5% due to steep increase in oil prices combined with higher food inflation as the prices of vegetables and fruits are at higher levels due to unseasonal rains destroying the crops and limiting the supply. Amid improved risk sentiment on the back of gains in equities globally, Rupee sharply retreated to test the high of 74.69 on Thursday last week. The global oil prices and US T-bond yields are trading very much higher, and the sentiment is definitely bearish on the domestic currency. It was rumored that some huge dollar inflows of about USD 400 million were sold in the offshore and local markets in the latter half of the week, which pushed up the rupee to trade higher. We do not expect the rupee to rise beyond 74.50 level on a sustainable basis, and the weakening trend in the domestic currency shall resume once the dollar inflows are absorbed by the market. After remaining volatile in the last 2 weeks time frame, we now expect the rupee to stabilize and trade in the range between 74.50 to 75.50 with a weaker bias. The increase in global oil prices would always exert pressure on the rupee to remain on a weakening trend. We firmly believe that the rise in global oil prices, which led to a sharp increase in the inland prices of petrol and diesel, can be limited to some extent by keeping the rupee stable at around the 75 level with the help of sell-side intervention from RBI. On the back of solid recovery in the rupee exchange rate, the forwards inched sharply higher across the maturities. After witnessing the rupee to sharply decline above the 75.50 level on 12th October 2021, the importers with unhedged payables up to 6-month maturities rushed for cover, which lifted the forwards sharply higher from the levels which had prevailed at the beginning of this week. The 3-month and 6-month forward dollar premium ended the week at 4.05% and 4.60% per annum respectively. In the last 1 month period, the 3-month forward dollar premium inched higher by 0.50% per annum. The paying interest for maturities beyond 6 months is quite low and can be observed from the forward market differential of less than 0.03% per annum between the 6-month and 12-month maturities. The forward curve is flat in the 6 to 12-month maturity brackets.